Hey traders, I hope everyone's having a good Labor Day weekend. Mine's been pretty busy, so I didn't really have a chance to make this video until today to recap my trades from last week. So I know Thursday and Friday were pretty rough trading days because of the drop the market took, so I hope everyone made out okay on that. I'll talk a little bit about that more at the end of the video, but right now let's just go through the trades that I took. So the first three trades were trade that I put on Friday 8/28. So the first one was Citigroup. I sold the 50.5 strike for expiration on 9/4. I received a credit of 45 cents and I was able to close it out 4 days later for 5 cents, and that gave me an overall profit of $400 because I did 10 contracts. The next one was TOL. I sold the 42 strike also for the 9/4 expiration. I got a credit of 61 cents, and then on Friday I decided to close it for a loss. I paid 2.15 for that. It gave me a loss of 1.54. I had 9 contracts, so that was a loss of $1,386. I decided to go ahead and close this out on Friday instead of rolling, just so I could free up some margin so that I wouldn't be at risk of a margin call if the market continued to drop on Friday. So I actually got out at a bad time because the market did recover some to where I could have closed this out Friday later in the day, actually for a profit. I would not have taken a loss if I'd waited, but that's okay. You know, there was no way for me to know that, so I wanted to get out of the trade just to free up some of that margin. But if it wasn't for that, I would have rolled the trade because I do expect this stock to be back up above 42 in the next few weeks. So I would have loved to be able to roll this and not realize this loss. But again, this was just to give me some more margin so that I wasn't going to go into the weekend using almost 100% of my margin. So by closing that out, that definitely helped put me back at a level where I was comfortable maintaining the rest of my positions. And in the grand scheme of things, it wasn't a big loss just because when you consider what I've made the last few weeks, that $1,300 wasn't really a big hit to my account. It was less than probably 2% of my overall account. LYFT was the other one I put on 8/28. I sold the 29.5 strike for 9/4. I got a 50-cent credit. I did roll that one to 9/11, and I got to lower it down to the 29 strike and got a credit of 0.08. And so you can see here, if I had not have rolled LYFT, I would have taken a $790 loss. But by rolling it, it keeps me in the game and waiting for LYFT to recover back above my strike so that I don't take a loss. And as of Friday close, I could have closed it and would only taken a $370 loss. And if the market does continue to drop this week and I need to free up more margin, this will be the trade that I will more than likely close. Again, because it will be a very small loss, assuming LYFT is still around the price it was at on Friday. So I could close this trade out and free up more margin as well if I needed that margin. As of right now, I don't need that extra margin. Tesla, I put on a couple trades in Tesla on Friday, 8/28. I made a comment that I was going to put on a debit spread in those trades to play the split. And so you can see I actually ended up doing 2 trades. I first got into the 445, 446 debit spread, and this is after the split, these strike prices. So you multiply that times 5 to get the strike prices it was when I put on the trade. And you can see that I paid a debit of 44 cents to get into that trade, and then I closed it out on Monday for 47 cents. It gave me a small profit of $150. I initially had done 10 contracts, but after the split, it was 50 contracts because you multiply it times 5. Also, I tried to get back in again on Friday into another trade because Tesla had dropped some, so I was going to get in at a lower strike price. So I got into the 44.2, 44.3 strike price debit spread as well. I tried to do 10 contracts, which would have been 50 after the split, but it only gave me 4 contracts that got filled before the market closed. So after the split, that gave me just 20 contracts, but I paid 45 cents for that, closed it for 5 cents, and that gave me a $100 profit. So just a small profit on those 2 debit spreads. Then on 8/31, I got into CHWY and FSLY. Both of those popped pretty quickly after I got in. I wasn't anticipating them to go up within just a few hours after I got in. I had planned to hold those probably through the end of the week, but since they did go up, there was no need for me to keep holding them. So in CHWY, I sold the 56 strike, received a 54-cent credit, closed it for 17 cents. It gave me a $370 profit. And in FSLY, I sold the 83.50. I got a 2.2 credit, closed it for 70 cents. It gave me an overall profit of $450. I did just 3 contracts there. For match, I sold the 110 strike. I collected 84 cents, but then I had to roll it on Friday. I got to roll it down to the 109 strike and still got an 18-cent credit. I only did 6 contracts for that, but you can see at the time of rolling, I would have lost $3,174 if I would have just closed it out and taken the loss. As of the close Friday, I'm down about $2,500 on that stock, but I will just keep rolling until the stock recovers, and hopefully I can keep rolling down the strike price each week. WDC, you can see on 9/1, I sold the 37 97 strike. I got a 57-cent credit, closed it for 15 cents. That gave me an overall profit of $420 in one day. RKT on 9/2, this was an earnings play. So I sold the 25 strike, and they're monthly options. They don't have weekly options. So I had to sell the September 18th expiration, which was 2 weeks out. I got a nice credit of 1.2. I did 10 contracts. So I'm still in the trade. I didn't have to roll it again because it's still got 2 weeks to go. I am down on it right now. I'm down about 1,300 on it because it is slightly below my strike price. I think it's around 24.50 right now. So I'll just hold on to this until expiration and hope that it gets back above 25. And if not, I'll roll it if need be. But the fact that it's at 24.50, I know that if it stays around that price by 9/18, that this option will only be worth 50 cents, right? Because it'll be 50 cents in the money and all the extrinsic value of that option will be gone. So I know that I'll actually will be profitable if it stays roughly where it is right now for the next 2 weeks, because I got a credit of 1.2. And if I can buy it back for anything less than that, even if it drops to say 24, I should be able to buy that back for $1 and still make a small profit of $200. So I would do that instead of rolling it, even if it is in the money, because based on the big credit I got, I have a lot of wiggle room for it to still drop to say, 23.80, and I could get out of it as a break even. On Apple, on 9/2, I sold the 126.25 strike price. I got a 97-cent credit. I did 6 contracts. I had to roll that one on Friday. I was able to roll it down to the 125 strike. At the time that I rolled it, I think Apple was like maybe 15 points below my strike price. So I didn't really get a great roll. I could only roll it down 1 strike price for a penny, but later in the day, Apple did recover to where if I'd have waited to roll, I would have gotten a better credit and possibly could have rolled it down even further, but that's okay. I'll just stick with Apple and keep rolling it until it recovers back above my strike. But you can see I would have taken a pretty big loss on Apple if I would have just closed it out at the time that I rolled. I would have lost $5,800 if I'd have closed out the trade instead of rolling. As of the close on Friday, I would lose a little over $3,000 if I were to close it out. But I don't want to take that loss. If for some reason I thought Apple would continue to significantly drop and would not recover, or that I wouldn't have the margin available to me to hold on to Apple, then I would close this out. But I feel confident that Apple will recover. It may not recover in the next few weeks, but I feel comfortable that based on me being able to roll down the strike price, that at some point it will recover, and I have enough margin right now to be able to maintain this position. If for some reason I did need the available margin, I wouldn't close out the full 6 contracts. I would just close out, say, 1 contract and not take that big of a loss, right? I'd rather close out 1 contract and maybe lose, $700-800 for that 1 contract, and that could free up a good bit of margin as well. So I would never necessarily close the whole position if I needed to free up the margin. Etsy's one I've been rolling for a few weeks, so you can see I started at the 123 strike and I've gotten it all the way down to the 117 strike. I got a credit of 6 cents when I rolled it this past week, down from 119 to 117. And you can see that if I were to have closed Etsy instead of rolling, I would have lost $3,800. The week before that, I would have lost $945. But since it went down even more, I would lose now $3,800 if I would have closed it instead of rolling. And then as the close on Friday, I was down about $2,800 on Etsy. But after the close on Friday, there was an announcement that Etsy was added to the S&P 500, and after hours trading, the stock had gone back above my 117 strike price. So hopefully this will be one that I can get out of this week and not realize a loss, and that will also free up a good bit of margin for me as well. Lastly, I had that SPY put that I had bought as a hedge back on 8/10. I decided to go ahead and close it out when the market dropped on Friday because it did give me a small profit in that position. If you remember from last week, I was down about $1,600 on that position. So I was able to close that out for a small profit of $84. So the main reason that I closed it out was because, again, I wanted to provide myself some more margin. And as long as I was in that put, I was not able to utilize that money as buying power. So I had to close out the position to free up, I think it was right around $3,000 I was able to free up. And that was just additional margin buying power that made available to me. So overall, I still ended the week with a profit. I had a profit of $588, even considering that loss that I took in TOL. But again, the important thing to consider as well, and the whole purpose for me adding these 2 columns, was I don't want to give a false impression that even with that market drop, that my account was not affected, right? Because you think, oh wow, Mark made $588 even with those big drops on Thursday and Friday. Well, yeah, that's because I'm only showing profits when I close out a trade. All the trades that I'm rolling haven't haven't been closed yet. So those in my mind are unrealized losses. So you can see as of right now, if I were to close out my positions, I would take about a $10,000 loss if I were to close everything out right now. I would have lost about $13,500 if I'd have closed them out instead of rolling initially. So this is why I'm sticking with the trade. I could have just closed it out, taken the $10,000 loss and be done with it, realizing that I made $16,000 in August. The month of August would have more than covered me taking this loss. I could have just wiped the slate clean, started afresh, and just closed everything out and just put on all new brand new positions. But for now, I'm going to stick with the trades that I have, waiting for them to recover. If I felt like there was any risk of the market really dropping a lot more, then I would decide to take some of those losses. But as of right now, I feel like it's just that it's profit taking and we were overdue for a drop, and I'm fine having to roll these positions for a little bit, waiting for that recovery to happen. And I still get a lot of questions about what if scenarios. What will you do if we have another March? What will you do if this happens? What would you have done if the market hadn't have recovered Friday and you would have had to close out more positions to get out of a margin call? And again, I just go back to those two videos that I've made. How much money can you make selling puts, and the what's the risk video. If you truly believe that the market can drop back down to the March lows, or you're fearful of blowing up your account, then you either need to not trade this strategy, or you need to adjust the number of contracts you're trading, or use a smaller percentage of your buying power. Because if you remember in the how much money can you make video, I showed several different buying power options and roughly how many contracts you should be putting on if you want to maintain that buying power based on your account size. This is the spreadsheet again that I showed in that video, and you can see that, let's say you have a $40,000 account and you don't want to have any risk whatsoever of blowing up your account. If the market drops 50% next week and you want to make sure that you have no risk of blowing up your account, well, then you're going to have to trade cash secured or the 20% buying power range is probably where you need to stick. You may could do the 40%, but if you wanted to be, have a guarantee you're not going to blow up your account, you need to be in this range here, the cash secured or 20%. Well, if you've got a $40,000 account, then you should be able to put on 5 trades, roughly 2 contracts per trade, and you should get around a 52% annualized return, roughly. That's just an estimate, right? And this is the very reason why I don't specify in my email alerts the number of contracts that I'm putting on. I mean, you can see the number of contracts I put on when I do my weekly recap, but I don't want to put them in the email and then people just start going blindly selling 10 contracts or 5 contracts, whatever I'm doing, and not taking into consideration their account size or the amount of buying power they want to use. Because if you have a smaller account than I have and you go in and put on those contracts, you may be at an 80% buying power when I'm only at, say, a 40% buying power. So that's why I don't put those contract sizes in the email, because I want you guys to do your own determination based on the risk level you're willing to take, on how many contracts you should put on, based on your account size and what buying power you want to use. Again, I'm a more aggressive trader. I've said this many times. I have no problem using 80% of my buying power. I have no problem taking the risk of blowing up my account. I'm fine with that because I've been doing this long enough that I know how to manage it. And if some freak event happens again like we had in March and I blow up my account, then so be it. I'm willing to take that risk because I want to get the 100% plus returns every year. And I'm fine taking on that risk because I know how much profit I've made over the years, that if I blow up my account, that I've pulled out enough money that it will suck by losing the money I have in my account, but I've already pulled enough profits to cover the amount of my initial investment into my account. And not everyone can say that. And I've said this again in other videos. A lot of my trade decisions that I make are based on my overall account and based off of performance that I've had, not just in the last few months, but performance I've had over the last few years. That goes into my decision making. And those are things I can't convey in an email, that you have to just make that own determination for yourself and realize that, if you're just starting out and you just funded your account with $40,000, you shouldn't be using 80% of your buying power, because there is a good chance you could blow up your account if we had a really big drop like we did back in March. You should start out smaller. But once you grow that account, let's say you can at some point double that account over maybe a couple years or 3 years, whatever the number is, you may want to take some more risk. You may be willing to push that buying power higher because you've got profits there to play with. And that's really how I'm looking at it. Because again, I pull out my profits regularly to where the money that I'm investing now, if I lost it, I've already pulled out enough profits that I'm not technically losing my entire account. So just take those things in consideration. I still get those emails and those comments I see of all these doomsday what if scenarios. scenarios. What are we going to do if the world comes to an end? Just don't trade the strategy if that's how you feel about it. I mean, I'm just showing you guys how I trade it. I'm just showing you guys what works for me. If you don't like it, don't trade it. Find a different strategy. Find something that doesn't require as much risk. You may not get as big of a return, but that applies to any strategy you use. You know that the higher returns brings higher risk. The lower returns brings lower risk. If you wanted the lowest risk investment strategy possible, you put your money in a bank drawing 1% interest in a savings account because you know there's a 100% chance you will not lose that money. And to get that guarantee, you're going to get a very small return on your money. I would much rather get a 100% return on my money, realizing that there is the risk that I could lose a significant amount of money. And I'm fine with that risk. And you guys just have to make that determination on your own, what risk you're comfortable with. And you can still do this strategy even if you're very conservative and you're not willing to take big risks. Then just do cash secured, right? I mean, you can still make a nice return, 30-40% a year potentially, doing cash secured puts. I feel like I've tried to be as transparent as possible, making sure you guys are aware of the risk. But I feel like based on the questions I still get, people think I'm somehow being shady or not revealing the true risk of this strategy. I've tried my best to convey that yes, you can blow up your account. That is a possibility that can happen. It's a possibility for me. And those are things you're just going to have to determine if this strategy is right for you. And if it is, then stay along for the journey. Just be careful with your buying power management and your contract size. But if you feel like that Thursday and Friday were too stressful for you and you couldn't handle the swings that occurred with your buying power, and maybe you were in a margin call for a moment on Friday, if those are things you can't handle, like I said, scale back your buying power usage or just don't do this strategy. There's a ton of other strategies out there that you can look through to find one that better fits whatever your goals are and whatever your risk tolerance is. That's all I got. Thanks.